Hi, I'm Thomas Steward. I'm an undergraduate finance major at Indiana University, and this is a podcast about the recent financial crisis for my Y376 International Political Economy class. The financial crisis began in late 2007. Before it officially ended some 18 months later, millions of Americans would lose their jobs and homes, and worldwide confidence in U.S. markets would be severely emasculated. Before I discuss how the financial crisis turned into the Great Recession, let's take a look at the events that led up to the crisis. Economists and financial analysts have yet to, and probably never will, reach a consensus on what exactly caused the crash. The documentary Inside Job, which we watched in class, cites deregulation in the financial industry, as well as broad conflicts of interest as two of the main origins of the crisis. A key part of deregulation was the Graham-Leach-Bliley Act, which repealed part of the Glass-Steagall Act and tore down the barriers between the commercial banking and investment banking industries. One conflict of interest shown in the film concerns the three main credit rating agencies in the United States: Moody's, Standard & Poor's, and Fitch. The film contends that these agencies were persuaded to issue AAA ratings, the highest ratings offered, to risky mortgage derivatives because payment for their services was contingent on the investment banks agreeing with their evaluations. This then led investors to purchase these derivatives under the pretense that they were as safe as U.S. government bonds. This semester we also read Thomas Friedman's Hot, Flat, and Crowded. Friedman blames the Great Recession on the "all be gone and you'll be gone" attitude in finance. This basically means that those involved in making dangerous investment decisions knew that they wouldn't be around to take the heat when things turned sour. On page 7, Friedman writes, "I'm talking about a broad breakdown in individual and institutional responsibility by key actors in both the natural world and the financial world, on top of a broad descent into dishonest accounting, which allowed individuals, banks, and investment firms to systematically conceal or underprice risks, privatize gains, and socialize losses without the general public grasping what was going on." Recently, the Senate Investigation Subcommittee released the Levin-Coburn report on the financial crisis. Senator Tom Coburn says, quote, "Blame for this mess lies everywhere from regulators who cast a blind eye, Wall Street bankers who let greed run wild, and members of Congress who failed to provide oversight." Like an inside job, the report asserts that widespread conflicts of interest were a key factor. Other experts have pegged certain macroeconomic forces, such as the low interest rate policy by the Federal Reserve and the United States trade deficit, as major causes of the financial crisis. I interviewed my uncle, Tom Borzilleri, who has a PhD in economics and over 35 years of experience to his name, to see what he had to say on the matter. Here's a link to the 15-minute video interview. Now that we've discussed some of the possible causes of the financial crisis, let's transition into what happened when the crisis actually hit. Late 2007 is when the crisis itself begins. Subprime lenders start to go bankrupt, while investment banks such as Merrill Lynch post losses in the billions. In 2008, these same investment banks collapse. Bear Stearns is sold to J.P. Morgan Chase for $2 a share. Merrill Lynch is sold to Bank of America. The financial crisis reaches its summit in September and October 2008. Lehman Brothers files for bankruptcy. A bank run on money market funds occurs. AIG needs an $85 billion loan from the Fed to avoid bankruptcy itself. The crisis turns global as it spreads to Europe at the beginning of October. The week of October 6th through October 10th would be the stock market's worst week since the Great Depression.
Back to the financial, we showed you the closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points. And with late-day trading here, we're at 689. These numbers, as we said, are still changeable. We could see a close, conceivably, 700 or larger. Michelle Caruso Cabrera has been watching this along with us for hours now. Michelle, is it possible to crack 700 still?
It's possible, and despite all of this, the U.S. government is still considered the best debtor in the entire world. If anybody's going to pay you back, so far, still, it's the U.S. government.
25 employees, and I have a warehouse, and I ship out...
Owner, you probably have a line of credit or commercial paper.
And Michelle, I should tell you that while you've been speaking in the lower corner of the screen...
Oh, there it is.
There it is, 738.42. Wow. That eclipses the previous larger single point drop record when the market reopened after 9/11 on 9/17/01. It went down a widely anticipated 684 points. But now we're down 738.42. Now, in percentage terms, you have a whole different argument. But clearly, this defeat in the House of Representatives today of this so-called bailout package was the shot heard round the world.
In that 1 week, the Dow Jones loses 22% of its value and is now down 40% from the same time the year before. Though the recession is still far from over, and there would be numerous aftershocks throughout the next year, by the end of October, the worst of the financial crisis is over. The International Monetary Fund estimates that large U.S. and European banks lost nearly $3 trillion on toxic assets and bad loans from 2007 to 2010. The United States GDP decreased by 6% in the last quarter of 2008 and the first quarter of 2009. The unemployment rate increased from around 5% before the crisis to over 10% at the peak of the recession. Responses to the financial crisis by governments and central banks across the globe have been hotly debated ever since. To deal with the immediate crisis, governments passed large stimulus packages while central banks around the world expanded money supplies. In the United States, stimulus packages worth a total of almost $1 trillion were passed. The U.S. government also passed the Emergency Economic Stabilization Act, commonly known as the Bailout Bill, after Fed Chairman Ben Bernanke told legislators that if the bill isn't passed, there might not be an economy on Monday. The act created the Troubled Assets Relief Program, or TARP, which allotted $700 billion to buy failing bank assets. At first, the bailout was expected to cost taxpayers hundreds of millions. More recent estimates put the number at only a few billion. The majority of funds lent to American banks have been paid back. AIG is on track to repay its $40 billion, and GM has already paid its loans back in full with interest. At the very least, TARP achieved its goal of creating liquidity to companies in wake of the financial crisis. The long-term responses of the federal government have generated even more controversy. On July 21, 2010, President Barack Obama signed a reform law as his response to the financial crisis. The law provides increased regulation of derivative markets and credit rating agencies, enhanced protection for consumers, and limits banks' ability to partake in proprietary trading, among other things. Many economists feel that not enough action has been taken to prevent another crisis from happening. For example, Inside Job ends by saying that in spite of all the new regulations, the underlying system has not changed. Banks that were previously thought to be too big to fail are now bigger than before, and the same incentives still exist. Additionally, no Wall Street executives have been prosecuted for their roles in the financial crisis. In his film Capitalism, A Love Story, Michael Moore attacks capitalism as a whole and claims that the economic system in America is what fueled the crisis. Toward the end of the film, he advocates rule by the people instead of rule by money. The government's responses to the financial crisis of 2007 to 2008 may or may not have been enough. Only time will tell. Regardless of political affiliations, we should all hope for all of our sakes that the former proves to be true.